Today I'm going to share with you a very powerful trading strategy that can be applied in forex, US stocks, and basically any financial market. This is the same strategy that has helped me generate significant profits over time. The strategy is based on combining multiple time frames together to build a strong directional bias before entering any trade. We will use 4 time frames: monthly time frame, weekly time frame, daily time frame. An entry will be on the 1-hour time frame. Let me repeat that again for clarity. We start from the monthly, then weekly, then daily, and finally we execute trades on the hourly time frame. Step 1, monthly time frame analysis. On the monthly chart, we focus on the last 2 monthly candles. We determine the direction of these candles, whether they are bullish or bearish. For example, if the last 2 monthly candles are bullish, then we classify the monthly time frame as bullish. This gives us our first directional bias. Step 2, weekly time frame analysis. Next, we move to the weekly time frame. We again look at the last 2 weekly candles and identify their direction. If they are also bullish, then the weekly time frame confirms the same direction. Step 3, daily time frame analysis. Then we go down to the daily chart. We analyze the last 2 daily candles and check if they are aligned with the higher time frames. If the daily time frame is also bullish, then we now have alignment across multiple time frames. Key principle, very important. The core idea here is alignment. If the monthly, weekly, and daily time frames are all pointing in the same direction, either bullish or bearish, then the probability of success increases significantly. This is a core concept from Dow theory. Trends must be confirmed across different time horizons. Step 4, entry on the 1-hour time frame. Once all higher time frames are aligned, we move to the 1-hour chart for execution. We look for buying opportunities near support levels or technical indicators such as RSI, moving averages, and key demand zones. This is where we enter the trade with confirmation, when not to trade. If the time frames are not aligned, for example, monthly is bullish, weekly is mixed, daily is bearish, then we do not trade. This is called a no-trade zone. In this case, staying out of the market is the best decision. Alternative short-term version. You can also apply the same concept on smaller time frames: daily, 4-hour, 1-hour, and entry on 15-minute. The logic remains the same. Alignment increases probability. Final concept. When multiple time frames agree on direction, market momentum becomes much stronger. But when time frames conflict, the market becomes unpredictable. That's why alignment is the key to consistency in trading.